Hello, my friends. Today is August 31st, and this is Markets Weekly. So finally, August is drawing to a close, and it's been an exciting month. Now remember, not too long ago, it seemed like the world was falling apart. But today, here we are, spitting distances from all-time highs. Now, whether or not this is a double top or we're just going to blast through, I think it's going to come down to the jobs market report this coming Friday. But until then, let's talk about three things. First, let's talk about some of the important economic data we got the past week, where it seems like overall the US economy continues to do well, but there are some definite cracks. Secondly, as we enter into September, market participants over the past, say, 100 years have noticed that September tends to be a pretty bad month for stocks and for gold. So let's talk a little bit about seasonality. And lastly, there's some really interesting research from the Fed just out the past week on the internationalization of the Chinese RMB, where the RMB, whereas far from being an international reserve currency, is making definite strides towards that direction. Okay, starting with the economic data. So last week, I think the most important economic data was the GDP data, where the second quarter GDP data was revised from 2.8% up to 3%. Now, at the same time, we also got consumer spending data that was better than expected and inflation data that was lower than expected. So the Fed's favorite measure of inflation, core PCE, printed at 2.6%, where it's been for the past few months. 2.6% obviously just a little bit above their 2% target. Now, the Atlanta Fed's GDP Nowcasting website, which takes into account all the latest economic data to try to forecast what current quarter GDP is, was revised higher from 2% to 2.5%. So looking across, the totality of this macroeconomic data suggests that the US economy continues to do fine. Obviously, if we're growing at 3.0% the past quarter, we are not in a recession, full stop. And as inflation gradually comes down, it looks like we're not in danger of a resurgence in inflation either at the moment. Of course, things could change going forward, but so far, I think it's very clear that the US economy continues to be in a soft landing. But that's not the only interesting data that we got the past week. Now, what caught my eye was the earnings report from Dollar General. Now, Dollar General reported their earnings the past week, and their stock totally imploded by about 30%. For those of you who aren't familiar with Dollar General, they're basically a chain of discount grocery stores that serve, let's say, primarily rural areas in the US. Now, the United States is a ginormous country, and there are many, say, towns with only a few hundred people there. At those towns, there's usually just one grocery store, and it's usually the Dollar General or one of its competitors. So Dollar General is a good insight, good window into how the lower income consumers are doing. Now, management of Dollar General through their press release noted that they are observing that their clients are getting stretched. So it seems like even as the aggregate US economy continues to do well, more and more people among the lower income segment are struggling. And maybe over time that will gradually expand and affect consumers higher up in the income structure as well. Now, when we look at consumer sentiment data, it looks like structurally speaking, consumer sentiment basically it has been lower over the past few months than we would see in earlier years. And also consumers are feeling that it's more and more difficult to find a job. Now, this suggests that, again, as we all see, the US economy, while not in a recession at the moment, is definitely slowing. And I think whether or not we actually do tip into recession is probably going to come down to what happens in November, where we have potentially huge policy shifts. But heading into that, there's going to be more uncertainty and people are probably going to cut back. So we're likely going to be in a slow patch for the coming months, as I wrote about in my blog the past week. Okay, the second thing that I want to talk about is seasonality. Now, the funny thing is that the stock market actually has pretty predictable seasonality. For example, the stock market tends to do very well in the beginning of the year. Now, smart people like Jim Carson have noted that this probably has to do with the fact that when asset managers come into the year, they are flushed with assets, new mandates, and they have to put money to work. Now, over the past, say, 100 years, one of the things that we've reliably observed in the stock market is that September tends to be a pretty bad month. Now, looking at this year-to-date returns over the past, say, almost 100 years, you can see that stock market tends to go up, go up, go up earlier in the year, and then when it comes to September and October, tends to do pretty poorly. Now, academics have also noticed this, and they've written papers on the seasonality aspect of the market, not just in the US, but looking across the world as well. And the truth is, no one really quite knows why we have this very obvious seasonality. Some people make hypotheses, like, for example, a lot of market participants are away on vacation during summer. As they come back in September, they rebalance their portfolios. Say maybe they want to do 60-40, and suddenly, because the equity market went up a lot, they rebalance by selling equities and buying more bonds or something like that. But basically, as people come back to work, maybe they rebalance their portfolio, and that involves some selling. Some people also think that, a lot of funds have their fiscal year end in September, and maybe at that time they have some withdrawals, redemptions from their investor base, and so they have to sell stuff and meet redemptions. But in any case, seasonality is something that is reliably observed. So September can be a bad month for stocks, and it certainly has been the past few years. But in addition to that, though, September seems to be a pretty bad month for gold. Now, it looks like, as Bloomberg is writing, that September has been a curse for gold over the past few years, where you see actually pretty sizable drops in the price of gold by a few percent. Now, I think this is particularly interesting because gold, as we're looking at this chart now, really has been going up a lot this year, and it looks like it's just at the cusp of new all-time highs, similarly with the stock market. So we're heading into a time where we have bad seasonality, and if this month is like the past months, it could be bad news. But remember, seasonality also suggests that things will get better as we enter into the last month of the year, the Santa rally, so to speak. But in any case, it's worth watching. Okay, the last thing that I want to talk about is this really interesting research done by the Fed, where this person, Professor Bershwitz, is doing a pretty comprehensive overview of the state of the Chinese RMB. Now, how do you evaluate whether or not a currency is becoming an international currency? Well, there's not one rule, but usually people think of it across a few dimensions. They can look at the share of foreign reserves, this currency's share of foreign reserves, or how often it's used in international transactions, how often it's used in international debt markets or international banking, and so forth. So they came up with this index on the internationalization of a currency, and they noticed that compared to the dollar, the Chinese RMB is, not an international currency. However, though, it's very clear that the pace, the trajectory is clearly moving in that direction. Now, when you look at the role of China's GDP, let's say, relative to the world, you notice that the Chinese RMB, as a percentage of, let's say, influence in the world, is disproportionately weaker than China's GDP as a proportion of the world. So it does make sense for this to continue to increase. Now, looking deeper, the research suggests that across a number of dimensions, the Chinese RMB is definitely improving, and the Chinese government is making a concerted attempt to try to improve the internationalization of the RMB. They're doing this in a few ways. They're setting up clearing banks in different countries. In the US, it's JP Morgan as well as one of the major Chinese state banks. And the Chinese are also setting up actually RMB swap lines with many countries, interestingly, not with the US. So in case, of course, anyone needs RMB, they can draw on the RMB swap lines. One interesting fact in the research is that Basically, when there's stress in the world, people don't draw on their RMB swap lines. What tends to happen actually is that countries who have very poor credit, like Argentina, draw on their RMB swap lines because they really need cash. But that could change over time. And so looking deeper in this data, you notice that now internationally, global trade tends to be conducted in dollars, but now Chinese exports, they are increasingly being invoiced in RMB, and that makes total sense. Of course, if you are a Chinese company and you're selling stuff, I think it's reasonable to expect payment in your own currency. So that is definitely increasing. And you can see that overall, over the past few years, the share of foreign reserves held in Chinese RMB is also still very low, but the trend is higher. And in addition to that, when you look at the share of Chinese RMB used in FX transactions, it's gradually increasing and now is actually used more frequently than the Canadian dollar. So this is painting a picture that the RMB is still very far from a reserve currency, but they're making strategic steps to try to make its adoption increase. Now, one major roadblock to the internationalization of the RMB is the capital account. So China, of course, as we all know, has a, managed currency where the RMB is allowed to appreciate or depreciate against a basket of currencies within a certain band. Now, one way to implement this is to have capital controls where the government restricts how much money people can take out of the country. Now, this has always been a sticking point for foreign investors because, well, let's say that you have a lot of RMB because you want to make RMB payments or maybe you want to invest in China. Well, one day, maybe, let's say you run afoul of the government or maybe there's some serious stress in the markets, maybe your account is limited where you can't withdraw money when you really need it. This is akin to, say, gates and withdrawals from an investment fund. Let's say you put money in an investment fund, but when you really need it, suddenly, because of gates, you can't get your money back. So capital controls are similar. And obviously, that's going to make international investors a bit more hesitant to invest in China. But that's something, of course, that can ultimately be changed in the future, although that would require giving up power by the government, which governments tend to not want to do. All right, so that's all I prepared for today. Thanks so much for tuning in. And if you're interested in my thoughts, remember to check out my blog at fedguy.com, or if you're interested in learning more about markets, check out my courses at centralbanking101.com. Talk to y'all next week.